So you want to know if you can actually afford a McDonald's franchise. Not the fantasy version where you buy a Golden Arches sign and watch the money roll in on autopilot. The real version, the one where a corporation with more financial scrutiny than most banks, decides in advance whether you're even allowed to try. Subscribe before we start, because by the end of this, you'll know exactly what a McDonald's franchise costs, from the liquidity requirement to the ongoing royalty, to the actual take-home pay a working owner-operator can expect. And you'll understand why the hardest part of this purchase isn't finding the money, it's proving to McDonald's that you already have it. Let's start with the number that stops almost everyone before they even get to a real conversation, the liquidity requirement. McDonald's recommends a minimum of $500,000 to $750,000 in non-borrowed, unencumbered personal funds, just to be considered for ownership, and that money needs to sit in genuinely liquid or near-liquid form, meaning your home equity or your retirement account sitting untouched doesn't count the way an actual bank balance does. On top of that liquidity screen, most current published guidance points to a net worth requirement somewhere in the $1 million to $1.5 million range, which tells you immediately that this isn't a franchise built for a first-time small business owner scraping together a loan. It's built for someone who's already accumulated real capital, often someone who's already run a business successfully or spent years as a McDonald's manager working their way up through the system before ever being offered ownership. Now let's talk about what that money actually buys. The franchise fee itself, the check you write directly to McDonald's for the right to use the brand, is $45,000, and honestly that's the smallest number on this entire list. The real cost sits in the total initial investment, which recent published ranges put somewhere between roughly $1 million and $2.7 million, depending on the format, the market, and whether you're building new construction or taking over an existing location, with a lot of sources converging around a $1.3 to $2.3 million range for a typical traditional restaurant. That figure covers real estate costs where applicable, though McDonald's often owns or controls the land and building itself and leases it to the franchisee rather than requiring you to buy the property outright. Construction and equipment, opening inventory, training-related travel, since McDonald's requires you to complete hands-on training before you're approved, and enough working capital to actually run the business through its early months before revenue stabilizes. Most new franchisees, in practice, don't build from the ground up at all. They purchase an existing, already operating restaurant from McDonald's or from a retiring franchisee, which changes the specific number but not the overall scale of capital required. Here's where it gets structurally different from every other business we've covered in this series. Because unlike a nightclub or a plumbing company where you're building something from nothing, McDonald's is fundamentally a real estate and royalty relationship dressed up as a restaurant opportunity, and the ongoing fees reflect that clearly. Franchisees pay a royalty running around 4 to 5% of gross sales directly to McDonald's, plus a required advertising fund contribution of not less than 4% of gross sales, which combined puts the total ongoing fee burden at roughly 8 to 9% of everything the restaurant brings in, before a single dollar of labor, food cost, or rent gets paid. And that rent is real too, since in the traditional model, McDonald's owns the underlying real estate and charges the franchisee rent on top of the royalty and ad fund, meaning a meaningful chunk of every dollar in sales flows straight back to the parent company through 3 separate channels before the owner sees a dime of profit. So what does revenue actually look like, and does it justify all of this? The average McDonald's location generates somewhere around $2.6 to $3.1 million in annual sales, with the most recent published average unit volume climbing above $4 million at the highest performing locations, which makes McDonald's genuinely one of the highest grossing fast food brands per location in the entire industry. Applying a net profit margin typical for the quick service restaurant category, somewhere around 13 to 14% once every cost is accounted for, a working owner-operator running a location near that median volume can realistically expect owner earnings somewhere in the $460,000 to $575,000 range annually, with some published estimates putting the typical figure right around $548,000 a year. That's a genuinely strong income, and it's exactly why McDonald's remains one of the most sought-after franchise opportunities in the country, despite the brutal entry requirements. But it also explains why McDonald's screens so aggressively on the front end, since a business generating that kind of owner income needs an operator who can actually run it well, not someone who's simply found a way to scrape together the minimum investment. Now for the stuff nobody warns you about before you submit an application. First, McDonald's requires a full-time, hands-on owner-operator, not a passive investor collecting a check from a hired manager. Which means this isn't a semi-absentee business model the way some other franchise concepts allow. And if your plan involves buying the franchise and stepping back to let someone else run daily operations, McDonald's structure simply isn't built for that. Second, the payback period is genuinely long by small business standards, with typical estimates landing somewhere in the 5 to 7 year range to recover your total initial investment based on median unit economics. And that number stretches considerably further for bottom quartile operators in weaker locations or with less operational discipline, while top performers can recover their investment meaningfully faster. Third, McDonald's franchise term runs a full 20 years, which is longer than most franchise agreements in the industry, meaning this isn't a short-term venture you test for a couple of years and walk away from if it's not working. It's a 2-decade commitment structurally built into the agreement itself. Fourth, the combined royalty and ad fund burden, that 8 to 9% of gross sales flowing back to corporate, sits at the higher end compared to a lot of other fast food concepts, some of which charge closer to 4 to 6% combined, meaning McDonald's premium brand recognition and proven system come with a genuinely premium ongoing cost attached. Fifth, McDonald's most current guidance shows a real preference for experienced operators and existing multi-unit franchisees over completely new first-time owners, meaning the path into ownership increasingly runs through years of operational experience, often as a McDonald's manager first, rather than simply showing up with the required capital and applying cold. So who's actually winning at this? The franchisees generating genuinely life-changing wealth are, overwhelmingly, multi-unit operators, people who prove themselves successfully running one location and then use the cash flow and equity from that first restaurant to acquire a second, a third, sometimes dozens more, since the fixed relationship with McDonald's corporate, the training systems, the supply chain, and the brand marketing all scale far more efficiently across multiple units than they do supporting the overhead of just one. Single-unit owner-operators running a strong location well can absolutely build a genuinely comfortable 6-figure income and real long-term equity in the business. But the operators building the kind of wealth that makes headlines are almost always the ones who reinvested their early profits into acquiring additional locations, rather than simply drawing a bigger personal paycheck from one restaurant. How do people actually lose money on this, or at least massively underperform the numbers above? Almost nobody fails because McDonald's the brand stopped working, the system is proven, and the demand is real. They underperform because they bought into a location with genuinely weak underlying unit economics, a market that couldn't support the volume the pro forma assumed, or because they lacked the operational discipline to manage labor costs and food costs tightly enough to protect that 13 to 14% margin, since a quick-service restaurant's profitability lives or dies on managing costs down to fractions of a percentage point, not on the strength of the brand alone. Okay, so let's put the real numbers side by side. A conservative buyer purchasing an existing location at the lower end of the investment range, around $1.3 million total, financing a meaningful portion of that after meeting the liquidity screen, running a location performing somewhat below the national average sales figure, might realistically be looking at owner earnings closer to the bottom of that $460,000 range in a strong year, with a payback period stretching toward the longer end of 5 to 7 years once debt service is factored in. Now the stronger version. An experienced operator buying at the higher end of investment for a well-located, higher-volume restaurant near or above that $4 million average unit volume, running tight cost controls and strong local management, can realistically land closer to that $575,000 owner earnings figure, or beyond, with a payback period on the shorter end of the range, and from there, reinvesting into a second and third location rather than simply banking the income personally, is exactly how the biggest McDonald's franchisee fortunes actually got built. So yeah, can you actually afford a McDonald's franchise? If the question is whether you have $500,000 sitting liquid and a net worth north of $1 million, that number alone disqualifies the overwhelming majority of people who've ever daydreamed about owning one. And that's entirely by design, not an accident of pricing. The real test isn't whether you can scrape together the minimum investment, it's whether you have the operational discipline to run a business where a few percentage points of labor and food cost management is the entire difference between a genuinely excellent income and a mediocre one. The franchisees who make this work aren't the ones who simply had the capital. They're the ones who understood, before they ever signed the franchise agreement, that they were buying a full-time job wrapped inside a real estate and royalty relationship, not a passive investment with a famous logo attached. Subscribe, and we'll do this again next week with the next opportunity that costs more than the sticker price ever tells you.